The highest interest rates in 22 years. The Federal Reserve just hiked them yet again. This video, we're going to discuss why it's not as dramatic as it actually sounds and what the actual impact will be for the Kansas City real estate market. Now, this was widely expected. Everybody was tipped off because in June, basically they came out and said, we're going to increase interest rates probably in July. And they have just done that. So you shouldn't expect a huge bump to mortgage rates because according to this article from Housing Wire, the entire mortgage industry has already priced this in. Now, not only was this rate hike expected, but everybody also expected another one later this year. The Federal Reserve just confirmed that they'll probably increase interest rates again in September, but they'll skip the month of August. And what that means for us in Kansas City is a few more months with mortgage rates above 6%. The big reason why this matters for us is makes it more difficult to purchase a home. Housing affordability with these really high mortgage rates has been at rock bottom lows. It also prolongs the housing shortage because everybody who does want to sell their home is just holding off because they don't want to trade their low mortgage rate for one that's really, really high. Propping up all of this is the high interest rates and inflation, which is still not where they want it to be. And it's not just Spotify increasing their prices for the first time in a long time, or my grocery bill going up by like $20. It's also housing prices. According to that article from Housing Wire, they say housing costs account for a large share of the inflation picture. They're not coming down meaningfully. In fact, shelter accounted for 70% of the increase in the CPI, which is the inflation data that the Federal Reserve is looking at when they decide whether or not to increase interest rates. So a large portion of that is coming back to home prices. Now, the guy in charge of all of this, Jerome Powell, who's the head of the Federal Reserve, had this to say about that exact issue. Said supply of existing homes is really, really tight, which is keeping prices up. There's a lot of supply coming on right now, but overall, it will take some time before it balances out. So you might be thinking like, whoa. Housing prices are causing a good portion of inflation. And at the same time, in an attempt to get the housing prices down, we're increasing interest rates, which is causing the supply shortage, right? Nobody wants to sell their home and get a more expensive interest rate. And that supply shortage, as he just said, is propping up prices. So we've got a big cyclical problem happening right now, and it doesn't seem like higher interest rates can solve it at all. According to a couple housing market economists, they said the Fed won't be able to bring down home prices and rents by raising rates further without doing significant damage to the economy. More supply seems to be the only solution. Another one added the only tool they have will not be able to move the needle because it can't address the housing supply demand imbalance without seriously hurting consumers. Now, that's definitely a huge problem, but we're going to put a pin in it for just a second because that same article did end with a little bit of silver lining. They said that even though this all means mortgage rates will probably stay above 6% for the time being, that the silver lining is that seasonality is returning, pointing to expectations of better values during the fall and winter months. In other words, basically the most competitive time of the year to buy a home is the summer, and as we move to the fall and the winter, there are more homes in the market. They stay on the market for longer. There's less competition. There's downward pressure on prices, meaning that all of this price-driven inflation that we're seeing, which is causing that cycle of higher interest rates, housing shortage, higher home prices, might subside just a little bit. So that is the home price cycle of doom that we're currently locked in, and it'll take quite a bit to get us out of that. According to this article from Newsweek, we're basically at a fork in the road, and whether or not inflation goes up or down dictates how long and how high interest rates continue to go. So they examined two different scenarios. The first assumes the Federal Reserve can hold off for a little bit, meaning inflation data looks good. It says if the Fed says it could stand by, then mortgage rates could drop. The housing recession will be over with more home buyers entering the market and perking up home prices. The second scenario is that if inflation data doesn't show decreases and the Fed has to raise rates even more, mortgage rates are likely to retest the cyclical rate of 7%, and home buyers will be sidelined for longer. Housing affordability problems, continuing the housing shortage, propping up home prices even more, all of the bad things that kind of continue this cycle of doom. The big question, when can we finally expect some relief in the Kansas City housing market? Jury's out until September, But if you subscribe to this channel, we'll keep you updated every step of the way. By that point, we should have a lot more information, a very good idea of what we're looking at over the next year or so, and what the big advantages will be for buying or selling a home in Kansas City. And of course, if you're at a point right now where you've got to make something happen, you got to buy or sell a home in the next 6 months, 12 months, etc. If you'd like to start preparing now, then if you think we'd be a good fit, feel free to reach out to me. All my contact info is down below. Phone call, email, text message. I know it looks like there's a lot of chaos happening right now, but there are always opportunities. Everybody's situation is different. If you reach out, we'll make sure to set up a time to talk about your situation and what opportunities are out there for you. So thank you for watching the video. I'll see you on the next one.